In this video, I continue the same example, except the journal entries this time will be for the lessor, Stoughton. So we already assessed this lease and read it carefully. Go on and take a look at how the lessor will calculate the payments. I explained it in the prior video, but just in case a quick repeat, the lessor will have to imagine that since fair market value of this asset is $40,000 right now, they would like to return all that amount, and they would like to impute or build in an 8% of return into the calculation. And this logic to calculate the payment is very much the same as we do for zero interest bearing notes. So in this case, your present value, $40,000, will equal the payment that we're solving for, multiplied by present value factor for an annuity due. And then if you take 40,000 divided by the factor, you will be able to solve for the payment itself. In this case, we will do the same present value, the same lease test like we did for the lease C, and we are ready to prepare a lease amortization schedule. And unfortunately, for whatever reason, when I bring in the PowerPoints, the headings do not show up right here. So we will amortize this large receivable in the same fashion as you will be amortizing, let's say, a debt instrument, like we did in the prior chapter. And we will be using an 8% effective interest rate. If you look at the journal entries, in this case, for the sales type lease, we will have an unusually looking journal entry right here. It might remind you of a perpetual inventory type journal entry where the lessor will record a lease receivable for the amount of $40,000, and then to match that, it will be also sales revenue, because in fact they did sell this leased asset. That's why it's called that's the name, sales type lease. We will then record cost of goods sold for $30,000. Please take a look at the prior slide when the cost to the lessor was given to you, and we will relieve inventory for the same amount. At the same time, we will also record a cash receipt as of January 1st, and then a reduction or a collection, partial collection of lease receivable. Then at the end of the year, very similar to the lease C, we will recognize interest revenue for the year, this amount, and we will increase our lease receivable. So then tomorrow, on January 1st, we will receive the full payment of $11,182. That consists of these two parts, a reduction in lease and then the interest part built in there. So if you look at it, there's no interest receivable, but it's rather lease receivable and lease liability. So we're not using interest payable account for the lease C. If you look at the balance sheet, in the current asset section, there's a lease receivable that we're collecting tomorrow. And then in the non-current asset sections, we have almost a $20,000 lease receivable that is still outstanding. On the income statement, how would you find all the accounts that are there? Just by looking, your sales revenue, $40,000, will be there right here, and then cost of goods sold will be $30,000. That's coming right from here. And then the last one, interest revenue, that you got to record through this journal entry. As we move into the next year, in a very similar fashion, the second lease payment will come in as debit cash, credit lease receivable, and then we will have to accrue our revenue for the year in the amount of roughly $1,600 right here. And again, it will not be an interest receivable, but rather it will be lease receivable. We go ahead and on the balance sheet show the current asset, the next payment of 11,182, and then your lease receivable as a non-current asset will be 10,000 roughly. And then on the income statement, we only have interest revenue. We already recognize the sales and the cost of goods sold in prior year. I would suggest to pause the video and go ahead and do the journal entries for year 3 and 4, and then compare what I have in my notes and what you decide or what you figure out on your own. So here is your third lease payment, very similar to what we see in year 2, and then fourth lease payment just on January 1st when you collect your last cash payment, and then you're done.